In the late 1990s and early 2000s, the dot-com boom was in full swing, and investors were pouring money into internet-based startups with reckless abandon. One of the most famous of these companies was Pets.com, an online retailer that promised to revolutionize the pet supply industry. With a catchy mascot, a sock puppet dog, a memorable jingle, "Because Pets Can't Drive," and a $300 million IPO, Pets.com seemed like a surefire hit. But just a year later, the company was bankrupt and out of business. What happened? In this article, we'll explore the rise and fall of Pets.com and what we can learn from its cautionary tale. Chapter 1. The Rise of Pets.com. Pets.com was an online retailer that specialized in pet supplies and accessories. It was founded in 1998 by Greg McLemore, Tom Herman, and Julie Wainwright, with headquarters in San Francisco, California. Pets.com quickly gained popularity with its unique brand and memorable advertising campaigns featuring a sock puppet dog named Pets.com. The company offered a wide range of pet products, including food, toys, grooming supplies, and even live animals. It also offered free shipping for orders over $50, which was a major selling point for customers. In just a few short months, Pets.com raised more than $82 million from investors, including Amazon.com, which was seen as a major endorsement of the company's potential. Pets.com was able to use this funding to expand its operations and establish partnerships with major retailers like Target and PetSmart. In 1999, Pets.com went public with an initial public offering, IPO, that raised $82.5 million, making it one of the most successful IPOs of the dot-com era. At its peak, Pets.com was valued at more than $300 million, making it one of the most valuable e-commerce companies in the world. The company continued to grow and expand, even as it faced increasing competition from other online retailers like Petco and Chewy.com. However, despite its popularity and success, Pets.com was ultimately unable to sustain its operations due to high costs and unsustainable losses. In November 2000, just over a year after its IPO, Pets.com announced that it would be shutting down its operations. The company's assets were liquidated, and its remaining inventory was sold off at a discount. Pets.com's failure was seen as a major blow to the dot-com industry and a cautionary tale of the dangers of overvaluing hype and potential over profitability and sustainability. Chapter 2. The Problems Beneath the Surface. The rise and fall of Pets.com was not simply a result of external factors or bad luck. There were several underlying problems with the company's business model and operations that contributed to its eventual demise. One of the biggest issues facing Pets.com was its high operating costs. The company offered free shipping for orders over $50, which was a major selling point for customers. However, this policy also led to significant losses, as the cost of shipping and handling often exceeded the price of the products being sold. Despite efforts to reduce these costs, such as increasing minimum order amounts for free shipping and negotiating better deals with shipping partners, Pets.com was unable to find a sustainable solution. Another problem with Pets.com's business model was its reliance on third-party suppliers. While this allowed the company to offer a wide range of products, it also made it difficult to maintain consistency and quality. Pets.com had little control over the supply chain, which meant that it was often unable to guarantee the availability of products or the timeliness of deliveries. This resulted in frustrated customers and lost sales. Additionally, Pets.com's marketing and advertising expenses were exorbitant. The company's memorable advertising campaign featuring the sock puppet dog was highly effective, but it also came at a steep cost. Pets.com spent millions of dollars on advertising and promotion, which was unsustainable given the company's already high operating costs and losses. Finally, Pets.com faced increasing competition from other online retailers like Petco and Chewy.com. These companies offered similar products at comparable prices, but with more sustainable business models and lower operating costs. This made it difficult for Pets.com to remain competitive in the market, especially as it struggled to find a way to reduce costs and increase profitability. In the end, Pets.com's problems were a combination of internal and external factors that ultimately proved too much for the company to overcome. While its unique branding and marketing campaign may have been effective in the short term, Pets.com's inability to control costs and maintain a sustainable business model ultimately led to its downfall. Chapter 3. The Fall of Pets.com. The fall of Pets.com was a result of a combination of factors, including the underlying problems with the company's business model and operations, as well as external market forces. As discussed earlier, Pets.com faced high operating costs due to its free shipping policy and reliance on third-party suppliers. The company was unable to find a sustainable solution to these issues, and despite efforts to reduce costs, it continued to suffer losses. Furthermore, Pets.com's marketing and advertising expenses were exorbitant, as the company spent millions of dollars on advertising and promotion. While its memorable advertising campaign featuring the sock puppet dog was highly effective in raising awareness and driving sales, it was unsustainable given the company's already high operating costs and losses. In addition to these internal factors, Pets.com also faced increasing competition from other online retailers like Petco and Chewy.com, which offered similar products at comparable prices but with more sustainable business models and lower operating costs. This made it difficult for Pets.com to remain competitive in the market, especially as it struggled to find a way to reduce costs and increase profitability. As Pets.com's losses continued to mount, investor confidence began to wane. In November 2000, just over a year after its IPO, Pets.com announced that it would be shutting down its operations. The company's assets were liquidated, and its remaining inventory was sold off at a discount. Pets.com's failure was seen as a cautionary tale of the dangers of overvaluing hype and potential over profitability and sustainability. The company's downfall had a significant impact on the dot-com industry, contributing to a wider loss of investor confidence and a more cautious approach to valuing and investing in technology companies. In conclusion, the fall of Pets.com was the result of a combination of internal and external factors, including high operating costs, unsustainable marketing and advertising expenses, increasing competition, and a loss of investor confidence. Chapter 4. Lessons learned from Pets.com's failure. The rise and fall of Pets.com taught several valuable lessons for businesses and investors alike. Here are some of the key lessons learned from Pets.com's failure. Profitability and sustainability matter. Pets.com's failure demonstrated the importance of profitability and sustainability over hype and potential. While the company's marketing and branding efforts were effective in generating buzz and driving sales, they were not enough to overcome the underlying problems with the business model and operations. Companies must prioritize profitability and sustainability in order to survive and thrive in the long term. Don't rely solely on marketing. Pets.com's memorable advertising campaign featuring the sock puppet dog was highly effective in raising awareness and driving sales, but it was not enough to sustain the business. Companies must focus on building a strong, sustainable business model in addition to effective marketing and branding efforts. Control costs. Pets.com's high operating costs, particularly its free shipping policy and reliance on third-party suppliers, were major contributors to its downfall. Companies must find ways to control costs and maintain profitability in order to survive in a competitive market. Adapt to changing market conditions. Pets.com faced increasing competition from other online retailers like Petco and Chewy.com, but was unable to adapt quickly enough to remain competitive. Companies must be agile and adaptable in order to stay ahead of the competition and succeed in a rapidly changing market. Valuations can be deceiving. Pets.com's initial public offering, IPO, was highly anticipated and attracted significant investor interest, leading to a high valuation. However, the company's underlying problems and inability to turn a profit eventually led to its downfall. Investors must be cautious in valuing companies based on potential and hype, and instead prioritize profitability and sustainability. In conclusion, the rise and fall of Pets.com offers several valuable lessons for businesses and investors. By prioritizing profitability and sustainability, controlling costs, adapting to changing market conditions, and being cautious in valuing companies, businesses can avoid the mistakes that led to Pets.com's downfall and succeed in a competitive market. Thank you for watching. Please let us know your thoughts in the comments below. Do not forget to subscribe and share.